I want to go back to a broader look at the U.S. economy. Is the recovery taking hold or not? Bond yields certainly tell one story, and there's fear that the recovery isn't taking hold. I'm joined now by Eugene Flood. He is president and CEO of fixed income manager Smith Breeden. He is also the chair of the investment committee at pension fund manager TIAA-CREF. And Gene is actually in town from North Carolina. Welcome to Bloomberg. Thank you for coming on to the program.
Thanks very much, Carla.
Now, of course, this week there's a lot of buzz over whether the Federal Reserve should be wading back into the market, buying treasuries, buying mortgage bonds, basically beefing up its balance sheet once again as it tries to guide the economy back to a more robust recovery. Do you think this is a good idea?
Yes, we do think it's a good idea at Smith Breeden. The way that this would likely be implemented, it's one of the three options that the Chairman Bernanke spoke about last week. And the way it would likely be implemented is that as the bonds mature in their current very large portfolio that's over $2 trillion, they would reinvest those maturing cash flows back into the bond market, into either treasuries or mortgage-backed securities. We think that that is a good idea, and the reason is this, is that anything that policymakers can do right now to stabilize the environment will help businesses make good decisions. Right now, corporations, as we hear from chief financial officers, tell us that the reason that they are concerned about making further investments, making further hiring decisions, is because uncertainty is just so high. Market uncertainty, direction of the economy, and then also policy and regulatory.
So this provides some consistency.
Exactly, and that is something that's very important right now to allow businesses to move ahead and make rational, long-term measured decisions.
If that's the case, I mean, recall when the Fed first got into the bond buying act here, everyone was saying that the Fed was really distorting things in the market. Now it seems like the markets can't function without the Fed playing a big role, or the government for that matter.
Well, it was important to have a lot of stimulus when the economy got in deep trouble. And that's normal, that the role of government programs should be to provide counter-cyclical measures. So when things get bad, government gets more active. When things are better, they can step back. And the hope certainly is that over time, they'll be able to step back.
Now, Europe is taking a very different tack with the ECB mulling ways of getting out, looking at an exit strategy. Is that more reassuring to have a government focused on fiscal discipline at that point?
It depends on where we are in the cycle, so that if there are still risks of a downturn, then what's most reassuring to the marketplace is to hear that the government is still there and ready to do more. If things are starting to heal and there's a lot of confidence around that healing, then the government can certainly start to talk about exit strategies.
Is there more confidence in the healing over in Europe?
Not from our perspective. I think from where we see growth in Europe being on the order of 1.5% to 2%, we actually see growth in the U.S. being more like on the order of 2.5%. So we think our economy is actually stronger than the Eurozone.
Okay, so they're taking the wrong approach in your mind.
I think they're talking about that a little too early.
Acting prematurely. Okay. In the meantime, we want to bring back our guest, Eugene Flood, the president and CEO of Smith Breeden, to talk more about the jobs numbers that just came out, which were disappointing. People were looking for a drop in jobless claims, and instead we got an increase. Can you give us your assessment on where you see job growth headed, no matter what the number is for July jobs?
Right. So these numbers are actually broadly consistent with what we've been expecting at Smith Breeden. We've generally been below consensus in our economic growth call. Specifically for employment, what we've been expecting to see is non-farm payrolls that were averaging about 150,000 first part of the year. That's where we've been. Going forward, what we're looking for is about 3% of hiring from companies over the next 12 months. That would take us roughly to the place where we've replaced about 4 million of the 8 million jobs that were lost during the downturn. So in 12 months from now, we will still be only halfway back to where we were in terms of total jobs at the beginning of the downturn.
So a long slog, certainly, for jobs.
Long slog.
Now, you are on your way to Switzerland. We're going to switch topics a little bit here to make a presentation on, among among other things, ratings companies. And I know your take on it is that the current system of assigning one rating is just too simplistic. You believe there should be more customized, individualized model. But isn't the problem, at least in the last credit crisis, that the analysts didn't perform adequate big picture scenario analysis? I mean, they kind of just assumed that housing prices would just continue rising. If you get the big picture wrong, it doesn't really matter what you say, what the details look like.
Well, that part of the statement is true. I would agree with you on that. But it really is a complex issue. And that lots of debate has been focused around whether the incentives are right. That is, whether a company that's paying for its rating through a rating agency, whether the rating agency will give that a fair rating, the conflict of interest, the issue. Also, the timeliness issue has been a big concern for people. But at Smith Breeden, we think the issue is really much broader, and that is the economy can go into very distinct, different states, and having one rating that tries to describe risk in each one of those states is far too simplistic.
Okay, gotcha. Thank you so much. I really appreciate your thoughts on all of this.
Thanks,
We've been speaking with Dr. Eugene Flood of Smith Breeden.